Good morning, everybody. Welcome back to Schwab YouTube Coaching Channel. It's our Monday edition of Trader Talk in today's market, and I am your host, Kevin Horner, joining you from a beautiful Denver, Colorado. And today we are running solo for all of you. I normally would have a guest with me on a Monday, but unfortunately, my buddy Jeffrey Avalos is out sick today. So we're going to go through the market here on a solo Trader Talk. We're going to hit up all the big areas of the market for you, as we always do. So looking at the major indices, looking at some sectors on the move, and we'll move on outward to some areas that we might not always get to, but we're going to try to touch on a number of key points for us on what is FOMC week. We are going to be hearing from the Fed this week, so plenty to be aware of as usual. Today, I am joined by Brent Moores in the chat, so take a moment and say hey to Brent. He'll monitor and get to comments and questions that I'm unable to get to in the Q&A, but you all know I try to keep an eye on this for all of you. I want to hear from you, so please feel free posting in there. For our duration, we'll go about 45 minutes in total. Don't forget to follow Brent and me on X, Brent Moores CS, Kevin Horner CS. You know, when the market changes a bit, as we've had the last week, things start to shift. And when this happens for me, it means a lot more individual equity posts. And I try to bring those to X as much as possible. It was a busy week for me on X last week with a lot of companies that maybe you hadn't seen in a while, or positions that have changed. And I love, bringing charts and things that come up to me throughout my workday and sharing those on X. So that's a big thing you get from me. And I know Brent likes to share the exact same type of stuff with a nice overview of what could be happening in the market. So a good reason to follow us on X. And if you're not already doing so, make sure you're subscribed to the YouTube coaching channel as well. All right, let's get to our disclosures so we can get to all the fun stuff. First of all, remember that our discussion here is exclusively for your information and your education. We do not make recommendations. We do not endorse any particular approach to trading the market here. We will discuss technical analysis, and as we do that, we always remind you this is merely one of your potential decision-making puzzle pieces. And what we discourage you from doing is making any decisions exclusively off what you receive in the way of technical analysis, but it can be a helpful puzzle piece in your decision making, and we encourage you to have a multitude of those puzzle pieces as you base your decisions. So more information can be helpful, but as much as anything, a plan can be most helpful. How am I going to enter this trade, and how am I going to exit it, knowing that in advance? Very, very important. As usual, we will follow our top-down methodology here. We will start big. S&P 500, NASDAQ 100, Russell 2000, semiconductors. We'll work our way through the sectors that are on the move. There's been some intriguing changes to a certain extent of late. Last week, we saw energy moving to the upper levels that it had seen of late. We'll see if there's been a breakout there. We'll definitely look at some of the futures aspects of the market, specifically for oil as it relates to energy. We'll take a peek at Bitcoin, which had a bit of a rough week last week as well. So we're going to touch on a number of charts in today's session. So with that, let's hit up the S&P. We'll see what we've got. The candle on Friday, a little less inspiring than we ultimately would like. You had a beautiful filled-in green candle for the majority of the day, and then we just kind of languished into the afternoon. Not a big deal because we ended up holding our level, as you can see. And today we're kind of flat on the open here. Now, the one thing that stands out, and I'm certain that some of you are already making note of this, hey, the S&P is up 2.5 points, or essentially flat on a percentage basis, but that VIX is climbing. And so let's just quickly remind ourselves of the likelihood behind this reason. The most likely situation as it relates to the VIX today is that we're getting an elevation here as a hedging protection against Wednesday's FOMC announcement. So Wednesday afternoon, 2 p.m. Eastern, we're going to be getting the decision from the Fed. Today, traders are positioned for an expectation of that 25 basis point cut. In fact, it's at 89% the moment I checked this prior to the show. So again, now, when we look at the CME Fed tool, I remind you this is merely how traders are currently positioned. So expectation of traders, where they are moving their dollars, they are of the belief that we're getting a 25 basis point cut on Wednesday. Now, today, with an elevated VIX, what you might be seeing is some hedging going into that announcement, one way or the other. We don't know. The one thing we don't know is very clearly, how will the market react to the announcement if we get that rate cut versus not? I would suggest that a lot of that rate cut expectation is built in to what we've seen in the S&P in the last 2 weeks. Reminder, the reason for our breakdown was largely tied to the idea that we weren't going to be getting a rate cut. And then we followed through with some reporting that was delayed due to the government shutdown. That delayed reporting came through, letting us know that the job market was a little bit stronger than expected. And the expectation since that job report hit has been for a rate cut. And that's been a lot of why you've seen this bounce. It's been about a 7 or 8% bounce off of the lows. About a 5.5%, almost 5.5% to the peak we made on Friday. But bigger in the Russell, our more interest rate sensitive index, of course. So there's been a lot of that discussion around what happens with a rate cut. Does the market continue higher, or do we simply just get a little volatility this week in expectation and result of the announcement, followed by a continuation of what's been happening? That's really the question. It's obviously difficult to know. What we can say as it relates to the broader market is and specifically the S&P 500, there are a couple of levels that you traders are probably watching, keeping an eye on, areas where you might choose to make an alteration to what you've been doing, or some areas where you would validate what you've been doing in the approach you've been taking. So if you've been a bull participating in the upside here, then you've probably been comfortable for the majority of the run, albeit this little period when we were below the 50-day, probably not as comfortable. But if we got ourselves back below the 50-day, the confluence of the 50 and the 20 here, let's call that under 67.50 on a close, probably see some traders positioning, lightening up S&P 500 shares simply by virtue of the fact that we got back under the 50-day moving average. So that could be an important level. Some traders would snap a line like I'm going to do right here and just put it right at that same level, because what we've got is a lot of confluence here, right? Prior high broke through, became a little bit of resistance, very little bit, but it's coincident with those moving averages as well. So we're going to watch this range, because if we're talking about it from a standpoint of management and you're feeling comfortable above the 50-day, uncomfortable below it, taking some off the table below the 50-day is a way that some traders would manage that comfort. And then on another layer, under that 65.40 zone, a close below there would likely bring more S&P 500 selling, meaning traders who've been long all the way would start to take a little bit more profit, not wanting to risk more downside. And the main reason being that once we take out or make new lows in here, we now have a potential for a broken trend, an uptrend becoming a shorter term downtrend. And we haven't gotten that yet. Okay. So if you're trading the trend, the majority of the trend has remained intact. Now, that's the view on the daily. And the one that I'm going to highlight quickly here on the weekly is the consistency of that green 20-week moving average. Remember, you might be watching a show like this one a couple times a week and looking at the daily charts, and that can be very appropriate for a lot of you shorter term traders. But if you're not a short-term trader, don't feel compelled to rely on the short-term charts. Pay attention to those longer-term ones. And I'm going to go ahead and eliminate my 40 and 100 weeks here. Just going to hide them real quickly by clicking the eyeball. And when I do that, the consistency of my green 20-week moving average really stands out here. If you're the trader who is more long range in nature, let's go back to this extended low from October of 23. You've had very infrequent instances where a trader would have said, you know what, I'm going to be defensive as it relates to the S&P 500 because we're below the 20-week moving average. This is, been working really well. Look at this. This was November of 23. You had one open below it, but notice the candle here was a weekly close right back above the 20-week. And then we didn't close below it with any conviction until here. This was March of 25. So basically, the November 23, March 25, about 16 months, we basically held that 20-week moving average. Now, we can't assign 16 months to the forward-looking period from when we recaptured it most recently, May, but if we did, it would look like something like September of next year. Okay, so that would be the timing, but we know better than that. We can't assign that. What we can do is say that from a longer range standpoint, if a trader were to see the S&P close below that 20-week moving average, a longer term investor might start to utilize that as a reason for more of a defensive posturing. Okay, that's what we're going to say as it relates to the S&P. Okay, let's take a look at our NASDAQ 100, up 0.3%. A little bit more of an optimistic viewpoint, as you can see here, everyone. The real significant move has been the break of the downtrend line. I'll draw that in as though it were just our standard pullback, because in reality, it sure looks like it, doesn't it? I mean, just as appropriate little channel, granted the pullback amount on a percentage basis, probably a little more than what would be standardized and comfortable for a lot of traders. Our peak here was at 26,182, and then our bottom came here on the 21st of November, and that was at 23,854. So looking at that line, approximately about just shy of 9% in a pullback. So right in line with, the pullback we get somewhere in the neighborhood of once every 12 to 18 months at that 10% level. Get those 5% drawdowns 3 to 4 times a year on average. So this was a pretty healthy drawdown after what's been a fantastic run. And the fact that we got ourselves out of that channel to the upside, have held that 20 and 50 confluence now for about 2 weeks, is starting to get everybody in the NASDAQ 100 a little bit more enthusiastic here. And I've noticed that with this move to the upside, if we kick this back to the weekly chart, you're going to see that this has been just a little bit more volatile because our instances working against the 20-week have been violated a little here and there, right? So where the S&P in those windows were a little bit more clear in terms of holding the 20-week moving average, you can see here that the NDX has been a little bit more difficult on the weekly basis to validate that. At least it was on the way up with that moving average. And I think a lot of that's just got to do with the volatility of the space. We're getting bigger swings because we get bigger moves to the upside, and bigger moves to the upside inevitably are followed by bigger moves to the downside. So we might get nice, big, strong moves up, but our pullbacks are going to be deeper than what you might traditionally see in a more casual grind upward style market. And that's not really, not a terrible thing, but it is something that we traders have to be positioned or at least prepared for. So traders of the NASDAQ should be familiar with, comfortable with a bit more volatility than we've seen. And of course, going back here to the May window, here's where we recaptured that May 12. Same period we recaptured the 20-week with the S&P. So we've been above that, some consistency back to May at least here. So we're going on about 7 months now of a pretty consistent trending scenario following all of the tariff conversation we had in April. So pretty good consistent look as it relates to the NDX as well. Well, let's look at our small caps and see what's happening here. Small caps are also up 1/3%, but they've been the biggest benefactor of the bounce back here. Let me highlight that that bull flag resolved very quickly and bullishly to the upside. So that's a lovely development for the short term and bulls who believe in the small caps. But you'll notice we once more have pushed ourselves into this ledge and have not busted through. Now, at least that for now tells us the most important level on the horizon for small caps, doesn't it? The bounce back here has been wonderful. From this low to the high, up about 10.5%. So collectively, again, the S&P bounces about 5.5 to 6. The NASDAQ bounces about 9, and the Russell 10.5. We take all of that. We recognize once more that it's all tied to the allocation of these groups, everybody. If we look again at what do we have to work with in the S&P 500. Where are the largest of our companies? They're all here on the over the left, right? It's all technology or communications. These biggest monster Mag 7 companies reside in tech and in communications. And the S&P, while it has all of this other stuff, these items like real estate, utilities, energy, materials, they tend to keep the S&P a little more under wraps, whereas the NASDAQ 100, if we take a peek at that, boy, that changes, right? Now, granted, that's because we're looking at 20% of the companies that we're looking at in the S&P 500, but here, look at the allocation discrepancy. Your utilities are there, but they're small. Hey, there's energy, but very small, and there's your finance, but very small. So if you're wondering, well, why is it that the NASDAQ is moving more aggressively? Why is it that the Russell has bounced back 10%? Well, it's all about the makeup and components of these indices, everybody. So quick reminder for you. One of the things we do on the YouTube channel, in addition to our daily live hosting, we provide some mini videos for you periodically. And I did put out 3 of those mini videos discussing the idea of understanding the component breakdown of the 3 big indices, the S&P, the NASDAQ 100, and the Russell 2000. You might want to check those out just to get a little clarity. I mean, it doesn't do a deep dive. It's all of 3 minutes for each section or each individual index, that is, but it does remind us of what we need to be paying close attention to, and also validates why we're getting moves that we are getting and why we're seeing the S&P lag on the bounce back versus the Russell, for example. So it's been a great move back in the Russell. Let's look at the weekly on it as well. Boy, you're not going to argue with this. I mean, again, new highs and holding our trend line. Again, we got the 20-week moving average here a little later in May. This was June. We did see we rallied to it on that same May 12 week, but you'll notice we had to pause in here. The small caps were a little bit of a lag. And then when the whole conversation about expectation for cuts again changed, we've seen a little bit of a continuation. So there's been consistency amongst the 3 groups here, and I think that consistency gives a lot of traders some comfort. One final call out on this chart that note I noticed and I can't help paying attention to. It's this candle here, where this week was a difficult one. That 11-17 week traded all the way down to horizontal support intra-week, but notice that tail tells us quite a bit about that week, doesn't it? So I bring this up because I know that a lot of you traders watch the show that we offer here, Trader Talk, 4 days a week. We talk about this stuff frequently on a daily look, but the weekly can be just as important. And the big takeaway is all of the technical analysis tenets, the foundations of technical analysis that we bring to the table on daily charts can be applied to the weeklies as well. Technical analysis, as we say, is fractal in nature, and the implication is that those tenets can be applied over daily charts, weekly charts, monthly charts, hourly charts, etc. Okay? Now, my great question here, Chris, I do tend to agree. I see a little bit of a cup and handle. We would call it maybe in the technician world a little more of a cup with a high handle, and that's because the handle itself is exceeding the left edge of the cup. So we might agree on this, but not it's in the my buddy Lee Bull would say this is in the spirit of a cup and handle, albeit cup with a high handle. I generally, or more, if we're trying to be more detailed and specific, if the left-hand side of the cup is like so, the right-hand side of the cup is like so, you might have expected something like this to be the cup right in here, or the handle, excuse me, right in here. This would be like the handle, right? Because traditionally, the handle resides below the level of the cup, okay? In this scenario, the handle appears to be above the cup, which is by no means a negative. It just means it doesn't fit in the definitive explanation for a cup and handle. But Lee and I having done hundreds, if not thousands of these classes together. That was one that he would say looks more like a spirit of the cup and handle or a cup with a high handle that exceeds it. Regardless, how do we manage such a trade or such a development? It's likely the same anyway. Waiting for a close over the peaks is perhaps the most important thing for short-termers, right? Because if you move through it, now you've got a new level against which to base support. And a lot of traders would say if you can clear that ledge that we've created and ran ourselves into here over the last few months, well, then if we clear that, that becomes former resistance, becomes new support, and thus an area against which to manage risk. Or alternatively, managing risk with the same 20-week moving average we've been watching all along. All right, I hope that's helpful, everybody. All right, let's look at our semiconductors. Semis got really big and strong. So I just got done talking about the importance and the strength of the Russell 2000. Look at the bounce back here on the semis. Semis moved exceedingly well. We go to today's high. How about a 20% rally in 2+ weeks? Everybody, that is about as good a bounce back as you're going to get, right? Can't be too discouraged by that. Yes, we are at resistance. Yes, the candle is uninspiring and breathing at the moment, but up 1% today, looking to continue and break out here, essentially suggesting that the conversation around AI and chips is not dead. There was a window where many traders thought, hey, maybe this is over. And that was, as we were figuring things out below the 50-day moving average, but instead we bounced aggressively off of this level. Now, an interesting thing from this bounce that I found, we could take a look at a couple of different things. I had been talking, and I love bringing a teaching moment to you all, but just to give a reiteration of perhaps why you might consider following me on X if you're not already doing so. One of the things I did post on X a few weeks back was looking at this consolidation window. And we talked about all the time in this class how consolidations tend to lead to trending windows thereafter. And following this consolidation, we did start trending against that 20-day moving average. In fact, we did so all the way until this day right there, that big candle. Now I'm going to incorporate this one as still up because this was a beautiful hammer candle and we did trade upward for 3 days. But the break right here, this candle would have been more or less the validation of the breakdown from the 20-day moving average. And so that was, let's see, 11/13, and we broke out of our consolidation on 9/10. So about almost 2 full months, essentially, of trending up against the 20-day. So what I did, I just took a quick snapshot. Some of you know that my middle name is Fibonacci, and I love to draw a little move here from that low in this consolidation before the rally began. So what do we get if we take our rally to here, to the peak? What did we do? We tested the 61.8% retracement. And I bring that up because as a teaching moment, if you're incorporating pullbacks, utilizing things like the Fibonacci's, commonly a trader will look for about a 50% pullback of any given move. And the important aspect when drawing your Fibonacci levels is to start from a layer where we begin a move to the upside or to the downside, right? So we could have drawn it all the way from back here where we had our extended low in April, or in my case, I drew it from when the rally got going again after the pause in the rally, which was what this consolidation could be considered to be. And the 61.8%, as a reminder, that's kind of, for a lot of traders, the last area of support, the last spot that, if held, tells traders everything that the trend has been doing can continue. And when we get notes of confluence, which is to say areas of importance that match up in a multitude of trading scenarios, well, then we pay close attention. And this one in particular, you got your uptrend working, you've got your 50-day moving average working. We broke the uptrend line, we broke the 50-day moving average, but we held horizontal at the 61.8% level. I mean, it happened to work out. The day that I posted about it on semis was actually the 21st of November. It's worked out. Look, I'm not, by no means am I a magician in any way. I just have seen these scenarios play out. Traders, if we pulled back to that 61.8% and this candle stayed red as it was that day, guess what? That would have been a sell indication for so many traders. Turns out it was a bounce day, and now we're up 20+% off of that low. Now, it's not going to work out that way, but what I want to do is, all the time that is, I want to bring you ways to think about what's happening. I want to show you ways traders will assess this stuff and start to formulate ideas and concepts, which should then give you the easy way to manage our trades, right? And that's ultimately all technical analysis does. Remember, technical analysis is not telling us, there is no crystal ball with technical analysis, but what it does is it helps us understand, where can I start setting my risk? If we trade through this level, can I raise a stop order? If I trade downward through a certain level, can I sell some of my position and build more cash because I'm less confident? Those are the things that technical analysis helps us do. So that's what we try to do in this show. So, highlight some of those important areas where traders might start making decisions. As we look at the stocks, we are at a very interesting spot here as to where we can start making new decisions, because closes at new highs on the semis, guess what? New highs, they're not bearish, everybody. All right, let's take a look at our sector action. Today, we're getting quite a breather. Look at the red on the screen. So we're taking the confidence and the strength of last week's close to looks like a little bit of profit taking heading into the week here today. Let's work our way down the sector list, starting with energy. I mentioned how energy had rallied into the top line of the downtrend channel. Look, the consolidation we've been under here. Add a little time, but 2 years. You can see, we've just made lower highs, but we've been dabbling at the upper range up here of late and establishing maybe a new short-term zone of support in the ballpark here around 680. Now, that seems kind of notable. A move to the upside here could be positive for the space as a sector. Now, what's not lending itself to energy, though, is the actual price of oil. And I'm going to highlight this with the futures quote just to show that we're still in that downtrend. Look at my 50-day moving average there, everybody. I'm going to change to just the 50 in purple and zoom in for us. And look at how consistent that 50-day has been as resistance. We're right back to it immediately here today. So can we continue the downtrend? Disinflationary as it stands out, because we like lower oil. We like the fact that oil remains under 60 a barrel, that we remain in a downtrend. This is positive for us in the way of inflationary numbers, most likely. And again, by the way, we got that delayed report last Friday. The PCE came through, and that number was a bit more soft than expected, and that kind of led to what we got out of the rally. So on Friday, that is. So the conversation around inflation, oddly enough, is that maybe inflation is a bit better under wraps. And yet, I know I don't feel like that. I'm sure you don't feel like that when you go to the local stores. I'm not getting that feeling by any stretch. And yet, I'm paying close attention here, because a rally or a tightening of supply in oil could prove to be inflationary yet again, and we'd have to be aware of that. So let's hope we don't see that. I don't want to see it, of course, but let's move on down our list here. Materials kind of let me put my moving averages back up. We're still trying to figure things out there. That's a real, you're not really trending on this one just yet. Industrials are in an inflection point, really. We're getting to a point of needing to see a break one way or the other, but this is one that, if you're looking for opportunity, industrials reside range bound like right now, like financials you'll see here momentarily. Likely those that are hitting watch lists and waiting for breakouts. Remember, just because the sector hasn't broken out doesn't mean you're not going to have some leadership in those sectors. I saw somebody posting about it earlier. Caterpillar has been doing quite well of late. Look at this maneuver out of Cat. Let's change this back to 1 year daily. yeah, so here's CAT trading at all-time highs after a nice little pullback to a 20-day moving average. So just because a sector hasn't broken to the upside yet, you could certainly find leadership that is already upward trending in your current sector. This would be an example of just that. And in terms of trade concept, trade approach, many a trader will look at those sections of the market, those sectors that are broadly sideways, and look for the leadership as ways to participate, because you would not be shocked if the whole sector broke to the upside to see that the move in Caterpillar is continuing rather than to pull back. It's unlikely. Doesn't mean it can't happen, of course, but your leader that's been carrying the group could easily continue to carry the group collectively on a breakout. So one reason to kind of keep an eye on something in the midst of consolidating like industrials right now. I mentioned financials. So financials, like I said, doing something very similar, but I'm just going to pick on two of them here for you. What about JP Morgan? Okay, now that looks a lot more like the actual sector, doesn't it? Pretty consolidative in nature here, matching lows, matching highs. But I think it's Goldman that's highlighting an uptrend. There you go. So Goldman clearly holding a trend line, breaking out recently. Whether you drew resistance back here or you drew it right here, whatever the case, it's moving right through it. So just one more way to be thoughtful. And when looking for those opportunities, just because your sector is in consolidation doesn't mean you're not going to find leadership elsewhere. So bear that in mind. Now, how about our communication? Oh, yeah, communications off a little bit today. We've seen this group continue to the upside. Remember that you get bigger moves in this one because it is has a smaller number of participants, of course, but ultimately bull flag here, resolved bullishly to the upside, holding on here off about 1% today, but not a negative by any stretch. Did make a new high there, intraday high and high close, new all-time good close there on Friday with good volume behind it. So positive there as well. What about our consumers? So here we've got discretionary, which has made a bounce back, albeit less enthusiastic of a bounce back here, everyone. Yes, we are above the 50-day moving average for the last week and a half or so. Some traders will use that to manage risk. Others might use the 20-day to manage risk, choosing to lighten up on moves back there. But, this is not terrible because we have held the 50-day now for, like I said, that last week and a half. It's just not bounced back as strong as some of the other areas. And that's what we talk about. Look, we try to remind us about what is relative strength. Well, it's outperformance in the short run versus others. Great bounce back in discretionary, but there are other groups that you could have done better with, is ultimately what we're mentioning there. Now, staples is, I'll tell you, the one thing that I think some traders keep taking away from staples is the fact that we can't get staples in gear. So each rally into the 200-day moving average of late has continually been sold. So you had this one that rallied through it, but found resistance at the 50. This one rallied to it and pulled back. This one couldn't even get to the 200 and pulled back. So once more, the defensive, traditionally speaking, staples kind of leads the charge from a defensive market posturing. Commonly, we witness dollars flowing into the staples category of the market, these being our most required items, right? The items that we need every single day. You need your toilet paper, you need toothbrush, toothpaste, etc. You need these things all the time, regardless of how good the economy is. And these are the areas that you would expect to be buoyant when the rest of the market is getting sold down. And yeah, there's been a bounce back when we made that low back in early November here, and it bounced back really well. And yet we're not changing trend. Lower highs, lower lows. So that might be giving traders a little bit of confidence to stick with what they've been doing in the way of tech, semiconductors, even small caps, because all of that implies for the traders that there is a comfort and a tolerance for risk that just a month ago wasn't there, or even 2.5 weeks ago wasn't there, right? Now, some of that's got a lot to do with the rates, right? But that's what we're seeing. So this is how we give thought to some of the machinations we've had in these groups. So Discretionary bounced back, a little less enthusiastic. Staples bounced back, found resistance, rolled over. Not ideal from a staple standpoint, but could be giving us a little bit more confidence from a standpoint of risk taking. Healthcare is pulling back. Now, this is an interesting development, everyone, because healthcare had been moving like gangbusters. I saw that term and it just stuck in my head here. That's absolutely right, Carol. So you're right about the discretionary stuff, by the way. Those figures coming through in the conversation around all of the holiday purchasing since Black Friday. But one thing that stands out, and this is anecdotal in nature, I suppose, but one thing that stands out to me might be the purchasing associated with buy now and pay later is maybe giving us a little reminder that just because we're spending doesn't mean we can afford to spend. That's not a win. Obviously, I mean, it's great to be able to spend, but if you're spending and you can't cover that spending, that could be problematic. And it is fair to suggest that, economically, we're seeing a bit more in the way of debt than we have historically. So that does stand out as a potential issue, especially for companies taking on lots of purchases in buy now, pay later status if they cannot, in fact, pay later as they suggest. So just keep that in mind. Now, from the healthcare side of things, breaking below the 20-day, today could be a decision day for some traders. If you've been a trader sticking with the healthcare for all the while, today's moves, what I'm noticing here, I'm draw that trend line, we're right on it. Okay. We are basically down to the cloth portion of our flag. So we are at a spot that will absolutely have to hold up strong, right? This will have to bounce from here, short run. Like if we're going to validate the trend and validate everything that we've seen in the way of the rally, this would be a good spot for that selling to run its course. Doesn't mean that it will, but it absolutely could. If we were going to consider the break of the 20 to bring us back to an important level of horizontal support, the first might be my green line. And if we added that extra year, let's see if we can just take a peek at healthcare here. You'll see why. So it was a peak back here. This was February, March, late February, early March of this year. And we rallied through it aggressively. So we're just building in technical 101 stuff here, everybody. Broke through resistance. Resistance can become support. And if we in fact break that 20-day moving average on a closing basis today, it does give us the potential to see 1740 on this healthcare sector as a potential zone of support. Last thing to do is just to see if that makes sense. Does that line up with a Fibonacci level? It'd be great if that green line comes in at around a 38 or 50% retracement. Let's see if that validates it. Oh, how about 38? So 1740 or so would be the 38% retracement of the move up we've made since just late September. That's not terrible. That's a bit of confluence. And notice the 50-day moving average is trying to get caught up into that level as well. So that does provide a zone of potential support for healthcare. All right. Looking at tech, which we basically talked about with our talks on NASDAQ 100, semiconductors, etc. We looked at communications, and today we are seeing yields pop. Okay, so this is significant for us because a pop like this in yields is going to need to reverse. That's a pretty intriguing spot, everybody. I've been talking about the need to maintain our downtrend in here, and you all see that we've popped through this. So let's just put this at 4.2 or 40.2. 42 even, excuse me, which is the same as a 4.2% yield on the 10-year. So we're going to put it right there, and I'm going to make it red. Yeah, so yield's popping today. I said that this was something we had to keep an eye on, and sure enough, rallying into potential resistance, but breaking the downtrend line is definitely putting a little bit of a squeeze on things. Notice how the higher yields is impacting utilities continuing to sell down, and real estate pulling back a little bit. Now, REITs are still going sideways in here, haven't broken down, but the move in utilities is kind of telling the story here. You can, if we're, again, capable of getting our yield in the form of risk-free rate of return through the 10-year note, well, then traders aren't going to be as comfortable owning utilities, which will carry good interest payments perhaps, but also carry capital risk. And not everybody's going to want to participate for that. So pretty significant development there. That I wish I would have caught that off the jump, everybody. Would have liked to have incorporated the yield with our move in the Russell. And that might be why we're seeing the Russell pause up here. And, honestly, if we do see a move through 4.2 to the upside on the 10-year yield, anticipation would be for a more of a breather in small caps, right? We would take that to stand out. That would be a big deal. Okay, that's about as broad a review as we're going to give here in Trader Talk to hit all of those sectors, all of the major indice groups. Let's see about a couple of stocks in the news this morning. I did mention Bitcoin. I wanted to talk quickly on Bitcoin, just because we saw that it broke down and is in the well, you can see what I thought of it, based on the pattern at least, is building a bit of a bear flag in here and failing at the moment at our 20-day moving average. So is our appetite for risk as strong as it has been? I'm not convinced it is. This is an important level. Today's high basically opened at the 20-day moving average. High from Friday, there as well. High from Thursday, there as well. But we've managed to trade through the lows of our high day, whether you chose the third or the fourth as the high day. The fact is we are under the low of the high day. Why is that important? Well, you all know why. If the high day in this bounce has run its course, well, then the first thing we have to do to validate a potential continuation of the downtrend is trade below the low of the day on which we made our high. Well, our high could be one of those two, and we're trading below the high of both of those at the moment. That is not ideal. So that implication is that we are at risk for this playing out bearishly going forward. We'll have to get back above the 20-day in short order for Bitcoin traders to feel really good. Ultimately, the continuation pattern here does not present fantastically on Bitcoin, as you can see. A move like so, that from the 20, where some traders might build their resistance or build their risk from, that's a pretty important level. And then the target zone suddenly becomes 65. That's not going to feel good for anyone trading that, right? So again, I can't tell you that that's what's going to happen, but I can say that things get more, the opportunity for that to occur changes as we get more weakness, right? The increase for more weakness comes with a continued breakdown of the trend. So we'll see if it plays out that way. All right. And then finally, for some of you, gold just consolidating in here. Notice that while we have a few red candles, this is basically just that consolidation, right? Break to new highs, hold the level. Let's see how that goes. Same thing with silver, except that silver is building the flag portion of the breakout here. Look at this. I mean, you can see it. It's pretty evident. And as JB and I have been talking, it might not be the price of silver that bears watching so much. It might be your group of miners and processors as much as anything else. But that's a pretty intriguing move. Silver has been absolutely on a tear to the upside. So bears watching. And then two big upgrades today that I wanted to highlight were in the financial space. I say financial, but really their technology, believe it or not, is MasterCard and Visa. HSBC upgraded both of these. MasterCard was upgraded to buy from hold with a new target at 633. As you can see, that'd be a nice premium from where we are if it ever gets there. But we can't say that that's a guarantee to occur. And then Visa also getting an upgrade, also from HSBC. Let me just clear my draw set here. And the pattern on these charts look a little similar. Their upgrade comes in from hold to buy and a new target at 389, another one with a healthy premium if it gets there. But by no means is that a guarantee to be achieved. And then one that I'm going to bring up that highlights for me is Oklo. So, one of those that had been a darling on the way up, and Oklo has quite struggled since, as you can see, peak to trough dropped about 58%. Not great. It looks like it's tried to set in a floor in here. They were upgraded at Seaport to buy from neutral, and they put a 150 price target on that. Another one with a healthy premium if it can achieve it. But again, from a trend standpoint, back above the 20-day at least gives short-term traders something to play with if they think that the move we had in the last week here is valid. Okay, I know I didn't get to nearly as many individual equities today, but I'll tell you, I hope we covered as much as possible in the way of sectors and broader index action today. And don't forget, we've got a lot to wait for this week with our FOMC meeting on Wednesday and then the commentary thereafter. So again, FOMC announcement, 2 p.m. Eastern Wednesday, and the testimony thereafter at 2:30 p.m. Eastern, when we might very well see the market start to react. So as usual, I really enjoy having you all join me. Thanks for being here today. Big thanks to Brent Moores in the chat. But more than anything, I appreciate all of you being here and participating. Following me on X is such a big something I'm very thankful for. Big help to me in building my brand and my name there on X. So follow Brent and me there on X. Make sure you're subscribed to the YouTube channel. And if you like this conversation, hit that thumbs up button for me below. We're going to get this reviewed and into the archive so that more viewers have access to it. And your thumbs up helps us out quite a bit. So with that, have a fantastic Monday, everybody. I look forward to catching up with you all again real soon.